Welcome to the Deep Dive. Today, we've got a really specific focus. We're looking only at the third quarter 2025 opening remarks from the CFO of a major tech giant. We're really putting on our financial analyst hats here, cutting through the noise, bypassing product stuff and drilling right down into the cash flow, the costs, and these, staggering investments they're making.
That's absolutely right. Our goal here is to give you a purely analytical view. Alphabet's Q3 performance, sure, but maybe more importantly, their strategic financial outlook. We're focusing just on the numbers, segment health, and where the true costs of this AI infrastructure race are really showing up on their books.
So if you want those distilled financial highlights, the strategic priorities, straight from the person holding the purse strings, really, not the vision seller, you're in the right place. You're about to get the deep dive into the true operational strength and the historic cost of being an AI leader. Let's jump in.
Okay, let's start at the top. The top line. What's the big headline number for Q3 2025?
The headline is just scale. Massive scale. Alphabet delivered what they called an outstanding quarter. They hit $102.3 billion in consolidated revenue, first time ever over the $100 billion mark in a single quarter.
Wow. $102.3 billion.
Oh, and that's up 16% year over year, or 15% in constant currency, fueled by double-digit growth pretty much everywhere. Search, YouTube ads, subscriptions, platforms, devices, and cloud.
16% revenue growth is, undeniably strong.
Yeah.
But here's where it gets interesting, right? The costs. The sources show cost of revenue was up, but only 13%. Okay?
Right.
The total operating expenses, they jumped a massive 28% to nearly $30 billion.
Yeah, $29.7 billion.
That's a huge surge.
That 28% increase, I think you're right, that's arguably the defining story this quarter. It really forces you to look past that shiny revenue number. Now, part of it you'd expect. R&D expenses grew 22%. They tied that specifically to compensation and depreciation for their big AI push. Makes sense.
Okay.
But the real kicker, the detail that kind of skews all the headline margins, it's hidden away in G&A, general and administrative expenses.
You're talking about that single colossal charge, the $3.5 billion one.
Exactly. The $3.5 billion charge related to the European Commission fine. The EC fine. So you look at the reported operating income, it's $31.2 billion. Looks like, okay, a moderate 9% increase, margin of 30.5%. But you have to ask, right, for you listening, is this huge fine just a one-off? Or is regulatory risk becoming like a permanent fixture in the P&L? A recurring cost?
That's the critical lens, isn't it? Because if you mentally back out that one-time fine,
Yeah.
if you look at the underlying operational health, the non-GAAP performance, well, the picture changes dramatically. Operating income growth jumps to a much more impressive 22%.
Right.
And the operating margin pops right up to a healthier 33.9%. That $3.5 billion hit really masked the true financial muscle this quarter.
And think about it, even absorbing that massive legal hit, the bottom line was still really robust. Net income increased 33% to $35 billion. And earnings per share, EPS, that was up 35% to $2.87.
And cash flow. The company's just generating capital like crazy.
Yeah.
Free cash flow, FCF, $24.5 billion for the quarter. They noted it benefited from strong operations, but also some recent tax changes on R&D expensing. And they ended the quarter sitting on, $98.5 billion in cash and marketable securities.
The balance sheet is definitely ready for whatever comes next.
Oh, absolutely. The foundation is solid.
Okay.
So now let's shift gears a bit and see which parts of the business are generating all this capital.
Right.
Because not all growth is the same.
Right. So the big picture looks great, even with that regulatory hit. Let's crack open the segments, see where the power's coming from. Google Services is still the behemoth, obviously. Pulled in $87.1 billion in revenue, up 14%. Search and other ads led the way, mostly retail and financial services driving that. And YouTube ads mirrored it, up 15% to $10.3 billion. And we should probably emphasize the subscription part here, too. The CFO really highlighted that segment covering subscriptions, platforms, and devices. That grew 21% to $12.9 billion. He specifically mentioned very strong growth in YouTube and Google One subscriptions.
That feels important strategically, doesn't it?
Yeah.
Moving beyond just ad revenue, getting that stickier recurring revenue.
Definitely a crucial diversification play. But that shadow of the legal fine, it definitely lingers right here in this segment. Google Services operating income did increase 9% to $33.5 billion, but the operating margin actually declined year over year, down to 38.5%. And that's because that huge $3.5 billion EC fine was booked entirely against the services segment.
Okay, so services took the hit on paper for the fine. Now contrast that with, the undisputed star of the show, right? Google Cloud.
Yeah, Google Cloud. Very strong results. Revenue up 34% to $15.2 billion. And crucially, the CFO pointed out that the growth rate for GCP itself, Google Compute Platform, is much higher than the cloud segment overall. They're really benefiting from customers needing that advanced infrastructure.
What does that infrastructure reliance actually look like? What are they selling?
It looks like their enterprise AI optimized stack. That's the term they use. So they're selling solutions that use their custom hardware, the TPUs, tensor processing units, and their integrated AI models. The CFO explicitly said enterprise AI products are already generating billions in quarterly revenue. Things like Gemini 2.5 driving demand for AI infrastructure. They're basically turning that cutting-edge AI research into actual bankable revenue right now.
And that success is showing up directly in profit efficiency, right? Cloud operating income surged 85% to $3.6 billion. And look at the margin expansion, from 17.1% last year to an amazing 23.7% this quarter.
Phenomenal jump. It suggests they've got real pricing power and they're getting efficient at delivering these specialized AI services.
And future revenue certainty, the backlog number was pretty eye-popping.
Oh, yeah. The cloud backlog hit a massive $155 billion.
$155 billion.
It's up 46% just from the previous quarter and up a staggering 82% year over year.
That's phenomenal traction. But wait a second. Signing that many huge deals. I mean, the CFO said more billion-dollar deals in the first 9 months of this year than the previous 2 years combined. Doesn't locking customers into these super long contracts carry some risk? Technological obsolescence. Especially if their own AI models and hardware are advancing so fast.
That's a really interesting point. It's a potential pressure point they didn't exactly dwell on, but it definitely underlies that huge backlog number. Raises questions about long-term agility, for sure, which, kind of speaks to why they need to keep investing so heavily, which we'll get to.
Right.
Before we move to Outlook, though, we should briefly touch on other bets. Revenue was $344 million, operating loss of $1.4 billion. Management confirmed they're reallocating resources there, focusing on valuable parts like Waymo was mentioned specifically.
Okay, so established. They're profitable, successful, seeing just unprecedented demand, especially in cloud. But this very success, as you said, it's forcing this huge forward commitment of capital. Let's shift focus completely now from results to the future. And this is where things get expensive. In Q3 alone, capital expenditures CapEx were $24 billion.
$24 billion in just 3 months. That's already staggering deployment, and the vast majority, as you'd guess, technical infrastructure, about 60% servers, 40% data centers and networking. But the real financial headline, I think the single biggest strategic reveal in the whole address, was the forward CapEx guidance.
Right, they revised their spending plans upward, massively upward.
Precisely. They're investing aggressively, they said, because of cloud customer demand and just overwhelming growth opportunities. So they raised their projected CapEx range for the full year 2025. It was $85 billion. Now it's $91 billion to $93 billion.
$91 to $93 billion.
Yeah. Just to put that in context for you listening, $93 billion is more than the entire GDP of some smaller industrialized nations. It's historic. An unprecedented capital commitment.
And it doesn't stop there, does it? The spending isn't just for 2025.
No. The CFO was explicit. We should expect a significant increase in CapEx again in 2026. So this isn't just a one-year catch-up phase. This looks like a multi-year, all-in financial bet on maintaining AI dominance, which, given their cash pile, maybe they can afford, but wow.
What's really critical, though, is the reason why they're spending so much, right? It's this demand versus supply thing.
Exactly. The demand-supply tension. Even spending this much, even improving how fast they build data centers. The CFO warned they expect to remain in a tight demand-supply environment in Q4 and throughout 2026.
Still can't keep up.
Yeah, specifically for AI infrastructure, those advanced TPUs and GPUs, they're spending almost $100 billion this year and still projecting they won't be able to fully satisfy market demand next year.
That demand pressure is just relentless, and it feeds right back into operating expenses, doesn't it? Higher CapEx means.
Guaranteed expense pressure later. Higher depreciation, absolutely. And data center operating costs, energy, cooling, staff. The sources showed Q3 depreciation was already up 41% year over year to $5.6 billion.
And they said that growth rate is expected to accelerate slightly in Q4.
Right. So you're essentially pre-funding future operating expenses today with this CapEx commitment, the sheer cost of running these immense new data centers. It's going to keep cost of revenues elevated. The core services are super efficient, sure, but the cost of this AI race itself, it's structurally increasing the cost floor for the whole business for a foreseeable future, it seems.
And speaking of Q4 costs, there was one more warning, wasn't there? about sales and marketing?
Sales and marketing expenses are expected to be heavily weighted toward the end of the year, supporting product launches, the holiday season push. So yeah, that OpEx pressure we talked about earlier, not letting up anytime soon.
Okay, so let's try to summarize the key tension here. On one hand, you've got unprecedented revenue growth, truly stunning margin improvements, especially in cloud. Amazing success. But that very success is running headlong into unprecedented demand, and that's forcing them to commit billions, tens of billions more in near-term investment just to keep up with capacity needs.
Yeah, the financial takeaway that just jumps out is the scale and the acceleration of that CapEx. $91 to $93 billion this year, another significant hike planned for 2026. It really highlights that the current battle isn't about market demand anymore, that's proven. The battle is capital expenditure and infrastructure capacity. Can they build it fast enough?
So given that explicit warning from the CFO, the tight demand-supply environment lasting well into 2026, it really makes you wonder, how much higher can this massive capital investment spiral before supply finally catches up with this explosive, accelerating AI demand? That financial commitment feels like the biggest story of the quarter, and it's definitely a question for you to mull over as you watch these huge companies build out their futures.
Indeed. A question we'll be watching closely. We'll leave you with that thought. Thanks for joining us for this deep dive.